Today, folks, I want to break down for you why I just invested $10,000 into this broad-based Canadian ETF called XIC. It's just a BlackRock S&P TSX index. I mean, super boring stuff, but it kind of plays into the field of what we're going to be discussing even right now, taking a look at earnings coming out of the stock market. We'll do some full breakdowns of this, but when you take a look at the volatility that just continues to persist in this kind of uncertain time, I mean, I'd like to imagine we're heading for a soft landing, but we all know that earnings are relatively deteriorating, not to a major extent, but we're obviously seeing like a slow in shipments coming out of Apple when it comes to Mac sales. I mean, you take a look at Tesla that just posted earnings and they just missed by little bits, but you're seeing them consistently lower prices of their products, which means they're losing their pricing power in this market. And not that that's a bad thing, they just want to keep up demand. Obviously, Netflix posted, we saw that company drop, and you just don't really know if you're coming or going in this market and who's actually going to come out on the other side of this doing okay. I mean, when I keep analyzing REITs, as I'd love to add some to my portfolio, some of them are just falling down like 70+%, and it's just kind of staggering to try and figure out exactly what is causing it. You're looking at the future cash flows from an interest rate environment. Interest rates are like gravity. They're going to consistently pull on the market, especially the companies that are swimming without their shorts on, as Warren Buffett would like to quote. So in this kind of nuanced market, I like the idea of using broad-based ETFs to keep that long-term exposure, but letting these stocks auto-weight themselves in and out based on their market cap, so I don't have to sit here and constantly analyze it while I have a full-time job at this point in my life. And just talking about some of these companies here, I mean, the Schwab US Dividend Equity ETF is one that I have just been piling into. Not only has it outperformed the S&P 500 over the last 5 years, but it's probably one of the easiest dividend stocks to buy in the US. I now have about 111,000 Canadian dollars invested in this, and I mean, it's probably the most pronounced dividend ETF in the States. I mean, the dividend 10 years ago was 12 cents a quarter. Today, the last dividend was 60 cents. I mean, the dividend growth here has just been nut barred. And again, you can't take past performance into future returns because, again, in a higher interest rated environment, that's what the last decade's been. And that's my fear when people talk about crypto and speculative assets, is though I think they could prevalently play a part in one's portfolio, they just can't be this massive positions. Like, you're just taking on too much risk in a higher gravity environment. It's not like we're going to get these 1,000% moon shoots like we've been seeing just because of the interest raised environment. Now, there'll be some exceptions. Again, everyone's talking about AI. Every AI stock under the sun is mooning right now. But again, it's not like we've seen through this decade. So I even think that gravity is going to pull down dividend companies. Like, we're not going to see dividend growth like we've seen in the past, presuming we stay in this high interest rated environment. S&P 500 is one that I obviously want. As many of you know, I'm trying to pair a broad-based ETF with a dividend-focused ETF in Canada and the US. And I'm going to try and weight this up to about $500,000 between these four ETFs we're going to be discussing. So yeah, I've got about 120,000 CAD right now sitting in the S&P 500's VOO, which again, over the last 5 years is up 55%, which looks like it's outpacing SCHD. But if you conclude that SCHD has like a 3.5% dividend compared to VOO's 1.5% dividend over that 5 years, you're surpassing the return with the dividend income. And again, I like having that steady cash flow that I can access considering the unstabilized job that I have. Even though I have a full-time job right now, it's based off contracted work. So I only get paid for the hours that I put in. I don't get a salary, so if there's not a lot of work one week, I'm not making as much money as some weeks where I'm completely slammed. So I do like that dividend income. And people are kind of unaware that the S&P does grow its dividend pretty substantially. Again, not that that's going to happen moving forward, but we're going from 56 cents a decade ago to today where we're getting about $1.49. So I mean, that's like almost a tripling, just under a tripling of the dividend, similar to SCHD, with really nice stuff, right? And then obviously, as we switch to the Canadian side of the border, my largest single investment in an ETF, VDY, which is heavily concentrated right now. I mean, VDY, 25% of this ETF is just in Royal Bank, in Toronto Dominion Bank. But I don't mind that because, again, I'm diversifying between all these ETFs, and I want to start kind of just pulling away. I did a portfolio review talking about my top 30 holdings, and you'll see that, RY, Royal Bank, makes up about 5.5% just because of the pure weighting it makes up in this ETF. And I'm going to start diversifying away from this with XIC, which we'll talk about in a moment. I love this ETF because it's monthly paying. All the other ETFs we're discussing are quarterly paying, and they all pay pretty much once every 3 months. They're not staggered, so I'm not going to get real big payments until 3 months from now. So that's just the way it is. But take a look at this monthly payment because it's a little staggered, obviously, but nonetheless, it is kind of condensing and continuing to raise up. So from like the peak of the dividends here on a monthly basis, we hit what? We can move that out of the way. The last one was in 2022 at around 21 cents. So 17 to 21 cents, give or take, going back a decade ago when we were only getting 3 cents to 7 cents. So we are seeing this concentrate and go up, which is super awesome for monthly income. Now to start diversifying, spreading out the risk here, I'm just buying into XIC, which is a much more diversified ETF. Obviously kind of counterweighting the S&P TSX 5-year performance up 33.7%, almost exactly in line with VDY. And XIC doesn't pay as a high of a dividend, so you might be thinking, why not just take the dividend ETF because like it's outperforming. But again, in uncertainty and more volatile times, kind of diversifying the risk a little bit might take away if the financial sector gets hit really heavy. And we'll talk about some of the weightings here, but taking a look at XIC, the dividend history, it's probably one of the longest standing S&P TSX ETF. So we do got history going way back on the dividends, all the way to the early 2000s, where you were only getting 5 cents a quarter, where today you're getting anywhere from 26 to 30 cents a quarter, roughly, give or take, or 27 cents. From a decade ago, 12 cents to 27. So not exactly doubling, not as crazy as the US. We're not seeing the same kind of returns or performance. But again, I do like the healthy diversification, and I'm going to explain to you why in certain periods like this, the Canadian markets could really potentially outperform the US markets. Now, when it comes to XIC versus something like VCE, these are both the same ETFs, but VCE has actually outperformed XIC. So why would I choose XIC over VCE? Well, let's just dive into this real quick. We'll take a look at some of the top holdings, which again is market cap weighted, very similar to VOO, but on the Canadian side of the economy. And the reason that I would much rather take XIC is not only am I getting institutional diversification, because I don't want all my money with Vanguard, VDY, VOO, Vanguard, SCHD, obviously Schwab, ETF, and then XIC is a BlackRock ETF. I like getting that diversification between institutions because there is institutional risk, right? But take a look at this because this one's a little bit more diversified. So you're going to see lack of performance in comparison to VCE. So Royal Bank, Toronto Dominion Bank, 6.5% of the holdings, Enbridge at 3%. If we go into VCE and we take a look at the top holdings here, you'll notice that it is a little bit more concentrated in those top weightings. If we scroll down here, it's way at the bottom, benchmarks, blah, 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 blah. Here we go. We can see Royal Bank at 8.2%, Toronto Dominion at 6.6%, Enbridge at 4.7%. So VCE, because it's more concentrated, will have better performance. But I'm getting that performance and that excessive yield from VDY. So I'm trying to split myself a little bit more from these financials and energy stocks. So that's what I can do with XIC. And again, it's going to limit performance, but give me long-term stability, because we can see financials in VCE are 40.9% and 17% energy in VCE. Going back to BlackRock, we can see financials are under 30% and energy is only 17. So substantial, difference in the financial sector aspect of things. So again, this is just kind of the path that I'm going in here. So I did put 10,000 today in XIC, which I'm very satisfied with. But let's talk about some of the other things that kind of I take into consideration, because I have been looking at things like XCI, which is the iShares High Yield Dividend ETF, and this is what I'm going to call your retiree kind of a stock. A lot of people want to talk about the option ETFs and those kind of companies, but I believe if you're my age, you're in your 20s or 30s, you're going to lose out, I think, on long-term sustainable gains growth, dividend growth from one of those option ETFs. They're more for like, I need money today. And if you don't need money today, I think it'll lackluster your performance. Same with these high-yielding dividend ETFs. I mean, you take a look at this one, for example. I mean, it's only up 28%. Not over the last 5 years. The 5 years has pretty much made up most of those gains. So you're not getting any real capital growth out of this. And when we take a look at the dividends here, going back 10 years ago, it was paying between for some reason it was really low, between 5 and 12, coming out of the financial crisis. But around 2012, you were getting about 8 cents, and today you're only getting about 10 cents. So, I mean, you're talking about not a dramatic increase. We're not talking about doubling the dividend in 10 years. We're not talking about doubling of the stock performance in 10 years. And that's typically like my minimums. I'm like, I need at least doubling of my return on capital every decade. So, I mean, all of these ETFs that I've talked about in the past have done that. And again, not that past performance equals future returns, but I'm taking the best of the best, the cream of the crop that offer that long-term history of performance. So if you're looking for income today, I think this ETF is amazing. I think option ETFs can be a huge proponent to your portfolio along with REITs, but I'm trying to avoid detrimenting the growth of my portfolio, and I'm not going to get it from an ETF like this, though you're getting about a 4.7, 4.6% yield. If I was older, if I needed it, if I had bills to pay for, I would be on this like you wouldn't believe. I think it would be a good little proponent to anyone's portfolio. But being young, I'm trying to average right now. My average yield is around 3.3 to 3.4%. across all of these ETFs. And I feel as though in an unstable job, I can tap into that without it hindering the long-term growth of my retirement. Because again, you want capital growth when you're younger, because historically that's where the vast majority of returns have come from. And if you have a full-time job, why even worry about dividends at all? Just put it into broad-based ETFs, S&P 500, maybe some growth ETFs that you're comfortable with. Set it, forget it for 30 years. But I don't have stabilized jobs. I'm not getting unemployment benefits. I'm not getting that kind of stuff, right? So I'm taking the dividends into mild consideration. Now let's just talk about the performance difference. Oh, let me not mess that up. It's really touchy. Let me zoom my head out a little bit here for you guys. So what you're looking at is the Toronto Stock Exchange since 2000. And it's really touchy here. Let me see if I can adjust this without messing it up. Because if I barely touch the mouse, it likes to go crazy. We'll just start from here. So you can see from 2000, during the dot-com bubble, this thing did drop off pretty dramatically, but it was able to hit new all-time highs during the 2008 financial crisis. Really healthy returns here, and this doesn't take into consideration dividends. In fact, I should be able to pull it up here. If we go back into XIC and we take a look at the long-term returns here, we go all, you can actually see that through this kind of dot-com era that it was able, with the dividends, to pretty much consistently hit all-time highs, like really stable growth throughout this entire history. You invested some money, I mean $10,000 back in 2001, like right during the dot-com bubble. Today you'd be sitting on about 44,000. That's a very awesome return, right? Presuming this is including the dividends. Whereas again, if we go back, so when you take a look at this era, because Canada hasn't been as tech focused, we didn't go through the dot-com bubble through the same experience. And because we're a higher yielding economy, it stabilizes some of the volatility in the actual capital gain perspective. If we compare it to the S&P 500 during the dot-com bubble area, we can see the dot-com peaked in the early 2000s, mid 2000s, and it never actually peaked all-time highs in 2008. It kind of just barely touched it, and you didn't see actually any capital rate of return roughly until about 2013. I mean, there was a long period of time here where you didn't see any capital return. And again, the yields just in the S&P are not that high. Yeah, you're going to be getting some kind of return, but during this era, the TSX actually outperformed. And I believe during periods of volatility and periods of recessionary environments, that's when people tend to turn to things like gold, precious metals, commodities, and that's what we're seeing. And that's the vast majority of what the Canadian economy is. Canada is one of the richest countries on the planet because of its commodities, right? So I really believe diversifying between these countries, between these currencies, that I'm offering much more stability and long-term growth in my portfolio. And we'll see how this pans out in the performance, as I will consistently update you month over month to see what the returns look like. And again, this is just the environment, and I believe this is as most passive as any human could possibly be. Outside of having to manage the individual stocks, which again, I still have small caps, I'm still really intrigued by some growth prospects. I just like the idea of having this as truly passive weighted. If I were to pass away tomorrow, unlike a lot of these dividend investors that own a ton of individual stocks, there's a lot less management over a 50 or 100-year period doing what I'm doing. And it's just kind of a really intriguing place I'm at going into my 30s. And I'd love to know what you think about this in that comment section below, because I'm going to be aggressively buying XIC at this point, start diversifying and kind of reweighting some of my Canadian income off of VDY.